thank you, Charles, again. Just before we start, I'll let our other two guests, Obi Nwosu from Coinfloor. Coinfloor was the first exchange to open here in the UK. It's been operating very successfully ever since. And Iqbal Gandham, who is the CEO at eToro, which I'm sure many of you have heard of, especially if you looked at any advertising hoarding or taxi cab in London in 2017. You probably couldn't have failed to notice them. But they were obviously one of the early retail, FX and CFD providers to focus on and look at Bitcoin and other crypto assets as well, with their founder having been heavily involved in the space from very early on. So, do you want to just kind of want to step back a bit, as I said at the beginning, go back, let's go back to start with and then kind of look forward. Both of you guys have been around early on, as I said as well earlier, this has evolved all out of retail. So there was kind of not much attention, then more attention. When we get on to maybe talking about some regulation later, regulators really panic about retail investors more than institutional or so-called professional investors. As well. Do you want to just kind of, each of you, just go through and tell us some about your experiences from the very early days, some of the challenges that you've seen up until now?
Good evening, everybody. As was suitably introduced, so my name's Obi Nwosu, and I'm the CEO and co-founder of Coinfloor. So we've been around since 2013, and we know blockchain is blockchain.info, so I suppose that makes us OGs. And we've seen a lot of change in this space. When we started, the number one exchange was Local Bitcoins, which was a peer-to-peer exchange. There wasn't any form of programmatic change. There were some before us. We're not the first, but everyone before us was hacked or gave away their code, including the private keys as open source, for example. But we are the longest running exchange in the UK. And we set ourselves up because we saw there were a number of problems in the space. There were problems around trust, reliability, and security, and that remains our mantra. But we did see at the time that it was basically a retail market. In fact, thank you very much for the talk. A lot of what you said, I completely agree with. And the headline for me is that what we're seeing now is that money itself has competition. And that's the key thing that we see nowadays. So we started off as a retail market, and that remained the case for a number of years. There was a period about 2 or 3 years ago where there was a lot of excitement about institutional, and we were part of that as well. We put a lot of effort in talking to larger institutions because we thought that crypto was ready for institutional input into the market. When we had these conversations, we started realizing that there was a lot of people kicking tires, but not necessarily interested in actually, or ready to, because of them being much larger organizations, ready to actually enter the market. We still see them entering this market, but as we'll discuss further in this conversation, we expect that to take a number of years before they're ready, and there has to be a lot of infrastructure that has to be put in place before they're able to come in. So more recently, we think that it's going to be a slow, gradual process. So we do still feel that there's a very strong element of retail in this market, but also we think we see the most exciting growth in the mid-market. So that's the sort of high net worth or professional trader on one end, but they're still technically retail. And at the other end, small to medium-sized corporates. So they're brokers and asset managers, hedge funds, proprietary trading firms, and so on.
Thanks, Obi. So I'm relatively new to the market. I started off in wealth management, launched this company called Nutmeg in 2013, 2014 here in the UK. And in 2014, that's when eToro first added crypto derivatives to its platform with about 2 customers. And then in 2016 to 2017, as everybody saw, crypto started to take off. We added further assets to our platform, moved away from derivatives to real assets, so you can buy Bitcoin and move it off the platform. What we realized was there was a change in the customer demographic in 2017. So in Q1, I would say it was the Shoreditch crowd. It was the developer who understood blockchain, not just any developer. In Q2, it was developers, technical people. In Q3, it was how can I put this? It was the people who had money apps on their phone. So the people who use Revolut or the people who use Monzo on their phone. And Q4, it was the hairdresser, it was everyone. Everyone was purchasing Q4. What we've realized again this year, so we thought that the people who wanted Bitcoin had purchased Bitcoin. But what we realized again, and this was last month and the month prior to that the customer increase when the volatility increased and the price went up, the customers inbound were in the same volume that we had in 2017. And these were, again, all new customers. And they came on far quicker than they did in 2017. So there's a plethora of customers out there, and we're predominantly retail, who are waiting to get into Bitcoin, who are verified with us, they validate with us, they've uploaded all their documents, and they're sitting for price movements and a better understanding of Bitcoin. But the interesting thing is they always hit the price when it's gone up, rather than buying when it's relatively stable, and I think that's an education process. The other thing we learned, and this year is slightly different to last year, just referencing your point on China. Last year, a lot of the volatility, price movements when the Chinese markets were open and weekends. This year, Wednesdays and Thursdays is really, really good for volume of customers. When Hong Kong opens, we see a lot of trades happening on our platform. For some reason, we haven't quite worked out why. We don't do any marketing in Hong Kong at all. So that's been an interesting one for us. And we're getting, and the other interesting thing is because we're a multi-asset platform, we compare the trades that we see in Bitcoin and XRP, and there's a lot of XRP, still trying to understand why, but there's a lot of XRP trades. We compare this to stocks. 10% of our customers who onboarded into crypto last year all went on to purchase stocks. So we're seeing this as a mechanism of getting people into investing and interested in investing. And this is the thing that all fintechs have been trying to do, get the next generation into investing. And we're starting to feel that it's the actual asset class that's going to get them interested rather than necessarily just the returns. They're passionate about talking about Bitcoin rather than talking about some ETF or portfolio they purchased and they have no understanding what the underlying asset is.
Thank you, guys. I'll get this one out of the way early because it kind of always seems a bit boring, but regulation. But it's come up in the news again, I guess, this week here in the UK. I'm sure all of you have been involved some way, a few steps. Managed to keep away from that side of it, Charles. I'm sure you two, I know you two have had kind of close conversations with our friends at the FCA here over many years. So the FCA this week came out with a consultation paper looking at derivatives, including CFDs, eToro offers. Do you offer CFDs still on crypto? Or
if you do leverage.
Right, okay. And they even brought in an ETN, exchange traded note, which is kind of an asset-backed security. CoinShares, who are based here in London, they launched XBT, which was the first ETN out of Europe 2 or 3 years ago. Traded on NASDAQ, and even the FCA have come out and said we're not happy with that product being offered to retail. On the flip side, if anyone's been following it, the FCA seems to have had a very kind of innovative approach. They've had the FCA sandbox, they've tried to encourage startups to come through, experiment. And that announcement, I think on the tail end of it, they even said, well, all of this stuff's worthless anyway, it's going to zero. From your experience, what's going on there? Because you've got this public face of the innovation arm saying, come on in, we're going to support you. And then an announcement like that seemed very regressive, really, from what's been going on.
So before I answer that question, anyone from the regulator here? It's always worth checking. So I think the regulator's been quite progressive in this. So my nighttime job is I'm the chair of the UK Crypto Association. So we do work with the regulator quite closely. So the first part of the jigsaw puzzle was I've forgotten the task force now, the name of the task force, the Crypto Asset Task Force. They came out with a consultation earlier on in the year. Treasury came out with a consultation. Now the derivatives team is coming out with a consultation. And the idea is to stitch all of these together by around Q1 2020. They aren't really looking at regulating exchange tokens, i.e. Bitcoin. You will still have to go through the Know Your Customer KYC and AML process, but they don't really want to regulate the exchange tokens per se, but they will regulate the security tokens. So I think the FCA have actually taken a really good approach. If I wear my anarchist hat, that's what I had to check if the regulator was in the room. I don't want Bitcoin to be regulated. I think it's very difficult for them to regulate and dot the I's and cross the T. But from a business perspective, I think there's 4 parts to the jigsaw puzzle that need to be completed for crypto assets to become successful. One is regulation. We did a survey of 250 people, I think, about a week ago, and I think 70% plus actually wanted crypto assets to be regulated. Age groups 20 to 50, 25 to 50. The second part of the jigsaw puzzle is custody. We need custody or third-party custody solutions. The third part is probably structured products, ETNs being one of them, or ETFs, or ETF 2.0, whatever you want to call them. And the fourth part is obviously utilization within the e-commerce platform. So I don't think there's anything way out there that they shouldn't be doing. On the derivative side, yes, I'm sure Ryan will have a point or two from CoinShares on the ETNs. From eToro's perspective, we are looking at the CFD perspective. We don't see why having a derivative in Bitcoin or in Ethereum or anything like that is any different to having a derivative in commodities or even gold. Sure, there is volatility, but a lot of the investors, there's no real link between leverage trading and increasing your risk if you know what you're doing.
Even the amount of leverage there's been?
So the leverage is already under tight control because of ESMA. So there's already, you can only do 1 to 2 on crypto as it is. So I don't understand why push that to 1 to 1. And also, if you don't do this globally, investors will just trade in, I don't know, Mauritius or Cayman Islands or something, and carry out leverage trading there. So they will still do it, but they'll just move to an environment which is completely unregulated. And I think that just exacerbates the risk.
Yeah.
So I agree that the regulators have, in the main, taken a very progressive view in terms of regulation of cryptocurrencies. One of the key decisions they made was that exchange assets, which are basically what I would call the money cryptocurrency assets that have reached a certain level of decentralization, so that's Bitcoin and Ethereum, are probably ones that they'd be willing to name. Others, it's harder to tell, are outside of their regulatory perimeter. Other things that look more like securities, for example, STOs, because they are similar to things that they understand and know, they're very likely to be, if not definitely going to be within the regulatory perimeter. And in the middle, you have these things like stable coins, etc., which they determine utility tokens and so on, which is where it's slightly vaguer, and we're waiting on the responses, which I think everybody's now given to the regulators in that respect. So Coinfloor was a founding member of Coinfloor Crypto UK, also of Global Digital Finance. We're no longer actively involved with all because from our direct conversations, I think we have the benefit of being around in the space for a while, our direct conversations with the regulators, it became clear a while back that they felt that although these attempts were to be applauded, that they felt they had to come in and put their own regulation in place ultimately. There are, in terms of specifics around derivatives, we last year launched the first physically delivered futures exchange called Coinfloor X. And upon launching that, it was a first of its kind. We decided that if you look at the objections to derivatives that the regulators have put forward, it was basically designed to deal with all of those. So they had 4 concerns. One was the focus on retail. It was institutional only. Another one was issues around manipulation. Physical delivery has significant properties that make it harder to manipulate, especially around the completion of a futures contract. Volatility, well, futures products and offerings and derivatives can help at scale reduce the volatility of a market. And the last one was utility. Well, physically delivered offerings have actual utility. For example, if you're a Bitcoin miner, you can use that to forward sell and lock in a price so that you don't have to worry about volatility and being bankrupt at the time you have to deliver. But even then, it was clear from reactions from the regulators that this was something that we saw the writing on the wall. And we eventually made the decision, after putting a lot of effort into it, to actually sell it. And we actually spun off Coinfloor X at the end of last year, and we sold it at the beginning of last year. And the new company is based in Hong Kong and doing their own thing, which is great. That being said, from my understanding and from my conversations, I do think that the regulators, the writing was on the wall for UK derivatives because there were I think there was a lot of underlying concerns by regulators around some of the excesses of what they thought that some of the excesses of the industry. there was quite excessive levels of advertising and marketing, not necessarily explaining the product and offering to a consumer-based customer base. And so I think that's probably why it ended up being, they ended up being so harsh in terms of their regulation.
Thank you. Charles, I mean, I was going to just say, I mean, if you look back, I mean, I wonder whether this is all being over-regged or if it's just because it makes so many headlines and has kind of gained so much traction so quickly. I mean, you can look at other markets and other assets which you might have ETFs which are based on very liquid products. I mean, we saw the Woodford thing a few weeks ago, which was based on all down to illiquidity. And if you look at something old like silver, I mean, that spiked up to 50 odd bucks 10 years ago and then crashed down to less than $15. So
I remember it well. I died on that hill. Yeah. More than once. Yeah.
But so I mean, like these things happen, but these things have been, these markets have been around for years. So is this just like regulators trying to kind of protect their asses basically? Because this gets headlines so frequently. Is it a case that over time it's like, well, we've seen all this before and it's not such an issue?
I don't know, and for the avoidance of doubt, I have no opinion about how any regulator does their job. Hopefully they'll do a good job, and we'll always comply. That said, that's the standard disclaimer. Okay. Look, these technologies offer a backbone that will offer a 5x improvement in capital efficiency for the banking system and a 1,000x improvement in safety and soundness. Okay. If they don't embrace the innovation that's coming to make the financial services sector, radically disintermediated and radically safer, it will be a massive, massive, massive policy failure, right? Look at London. London has the financial talent, the technical talent, okay? The regulator, the government, and the central bank all right here. This should be an absolute hub for fintech innovation, par excellence at global scale. In fact, better than anybody else in the world. Literally nowhere else in the world has everything that London has, right? Like, if London as an ecosystem and the UK as an ecosystem doesn't seize that opportunity, I mean, that's just a huge policy failure, because at the end of the day, these technologies offer the prospect of handing massive amounts of value back to users with a step change order of magnitude increase in safety and soundness. Self-custody is, for the avoidance of doubt, the solution to too big to fail. Fact. I believe it with every core of my being. Okay, and that's why I'm here. And like, that's a really great thing to work toward. And I think that ultimately the policymakers will understand that. And I'd be happy to wax poetic about that all day long. To anybody who wants to listen.
Well, I agree. Even better, you've got shared custody, because you've got multi-sigs and you can share custody across multiple parties.
Yeah.
I think, the other part of, we'll move on from regulation, but I think the other bit of news this week, I don't know if I'm sorry, but the SEC put an RFQ out for an existing off-the-shelf blockchain forensics platform to offer their services to them. So on the other side, you've got regulators saying, well, we need the tools, we want the tools, and actually these tools can potentially offer us things that we can't get in any other market. It's like, we want to see everything that's going on the network. It specifically asked for to include Ethereum and to be able to track any assets on top of Ethereum, look at history. It should be a regulator's dream, really, in theory, and I think maybe they're just being a little bit slow in catching up. I think maybe they'll get there.
Sure hope so.
They tend to in the end. So what about if we're moving in that direction and we'll kind of let the regulators do their thing? And look, I do agree. I think they have been proactive, innovative. If we go back to the OG days and when, before all this kind of exploded, I think it's kind of well exceeded everyone's expectations in terms of how it would be greeted. I think the assumption then was this, like, everyone from every bank, every regulator, every government would just try and come down on this like a ton of bricks. But they haven't, so I think that's a positive. So I think we're heading in the right direction. It will take time. But in terms of the broader infrastructure, so we've kind of seen the retail space evolve. It's pretty well, it's maturing. The retail space, it has everything there. The regulators might have their say. And now we're stepping into the main, sort of the points you touched on around institutional kind of participation. Custody seems to be the big thing. I guess one of the flaws that I kind of focused on myself quite early on, looking at the current exchange infrastructure, is that your typical crypto exchange is a custodian, an exchange, a broker all rolled into one, and that's not kind of how it flies, how the market's kind of rightly so. And so we're stepping in that direction, and we've had some very good early independent crypto custodians, the likes of Elliptic started quite early on, Zappo. You've got the Vault guys here in London, obviously people like Coinbase offering their services and others. But there's still been a question mark over those guys, because they're startups at the end of the day. I know that some of them have got very good technology and they're kind of very good operations. But for the institutional guys, they don't have a balance sheet, they don't have a reputation that goes back 100 years. So when Fidelity comes in, does Fidelity have any, do they have better technology? Then this is not an assessment of Fidelity's technology, I have no idea. But there's nothing to say their technology is any better than another startup that's been operating in this space for a while. But they're probably going to earn their stripes because and get the business because they're Fidelity and they've got a huge balance sheet. So there's the custody side. There's obviously the rules and regulations around exchanges as well. How do we see that evolving from this point?
So I'll take this one, thank you. I think there's two parts to that I want to answer. One is that we're seeing history repeats itself, and we're going to be seeing the great unbundling of crypto exchanges, we predict, over the next 12 to 18 months. Why? Because it's just common sense. I mean, when you start off as a small industry, you have to do everything yourself. If you're in a small village and you're gonna farm for wheat, and then you're also gonna cut the wheat and then mill it and potentially be the person who's the baker as well. But as you get to scale and you get success, each one of these different skill sets require different specializations, different types of people to be able to do them well. They have different cameras and timings to them, and so it makes sense to have specialized organizations that do this. Is this a unique thing? No, it's not unique to crypto, it's not unique to even financial services. Pretty much every large industry starts to specialize at some point. And so we're going to see the same thing as we see in other industries. In crypto, what that's going to mean is you're going to see two forms of split. One, you're going to see exchanges split into, we predict, 3 verticals. You're going to have, and then one sort of quasi-temporary vertical. So you're going to have crypto stock markets. They list lots of stocks, whether they're altcoins or STOs or whatever. The examples of that are people like Binance and so on. You're going to see crypto derivatives platforms or exchanges, and there are people like maybe eToro and also including BitMEX, etc. And then you're also going to see crypto commercial banks. This is the one thing that's probably the most nascent. Many people could be that, but they're currently not, because they're in this quasi-group, which is the everything exchange, which is they're still a member of the past, where they're trying to do literally everything to be. But the other side is markets that we focus on, because again, you'll see this, and again, this is not unique to crypto. You're going to see people who specialize in retail, consumer retail. People who specialize in the mid-market, which is the sort of the high-end retail. They could be the places in Mayfair and so on, or they are those places in Mayfair, hedge funds, asset managers. And then the people who specialize in the institutional. Again, the needs of those customers are very, very different. So to try and be good at all of them, to be jack of all crypto trades, you end up a master of all, is going to be very, very difficult. So right now, you've still got a few organizations who try to do everything, and examples are obviously people like Coinbase and Binance and so on. But as these markets become more mature, they're going to either have to pick, like on the roulette wheel, they're going to have to pick a place to go, or they're going to find that they're competing with everybody on multiple quarters. All these people are specialized and focused, know who their customer is, know what segment they are in and what they're trying to service, and they're going to fail to compete against each one. Clearly, we think that we should specialize, and we have 3 different organizations who each one deals with a different, we think, lucrative pairing of customer client base and vertical. So that is what we expect to see in the markets over the coming period.
Iqbal, I mean, eToro just launched a dedicated crypto exchange as well, so you're also looking at.
Oh yeah, we have. Yeah.
Well, that's mentioned.
Forgot to mention that.
Okay.
Yeah. Oh yeah, we've launched a dedicated. Yeah, we've.
Physical exchange.
Yeah, we've launched eToro X, so it's still in beta. The idea there being, it lists multiple assets, hundreds of assets, etc. But just coming back to the custody point, it's quite relevant. So I was on the phone to a company 2 days ago regarding custody. The big players are coming into this market. So we do, because we offer stocks, we have partnerships with custody providers such as State Street, etc., to do the custody of our stocks. So there's 2 ways of looking at this. From a customer perspective, if customers come to our platform to buy shares in Facebook, they really don't care where the custody of Facebook shares is occurring today. So I think moving forward, I think as the mass market enters Bitcoin, they're not really going to be interested where the custody is happening. From a company perspective, yes, we need to look at the custody solution. So the traditional banks are entering this space. They will be live with their solutions Q1 2020. They're still trying to work out the commercial models. The biggest concern they've got on offering custody solutions is insurance. So insurance is one of the industries in crypto which is really, really lagging. And I read today that Coinbase is looking at going into insurance, etc. I didn't read the article, but read the headline. So insurance is what's lagging. So if I outsource my custody to a third party, irrespective if it's a Fidelity or XYZ, if they can't offer me insurance and they're using the same technology as me as a company, I don't really care about their balance sheet. I want them to really offer me custody and secure my crypto, hence insure my crypto, but they have no insurance products to leverage insurance from. So I think those 2 things need to work together, and once we have that, and I think it's Q1, Q2 2020, then we'll start outsourcing our custody, because the technology, whether they want to use it as Apple or develop their own storage system, the technology is pretty much out there, and they're just going to build on top of those layers.
Do you think that on the custody side, the technology needs to evolve itself anyway? Because it's like this very futuristic technology that you talk about. Custody is just ridiculous. I mean, it's easier to store gold. It's easier to insure gold. It's easier to, if there has to be a claim on a gold robbery, it's going to be easier to for the insurance company to validate. Well, the problem with the insurance, I guess, we need people to get insurance, and then we actually also need it to be tested, and for there to be a hack to see if the insurers pay out.
Well, yeah, so I'm not sure if I call it a test, but I think the thing with technical solutions is this industry's moving so quick. Everybody's developing different blockchains, and Ledger will deal with some of them, and Zappa will deal with others, etc. So it's very hard to keep pace. So as a business, I just want insured. Whatever technology is being used, as long as I know our customers are covered, I'm okay. And I think that's where the gap is. I think we're always going to be playing catch up with some of the technology. Maybe in a year, 2 years' time, we'll say 90% of the blockchains, etc., have been covered, and those coins can be stored securely, etc., etc. We develop the technology for it. But even then, I still want somebody to insure me and to say, well, if something goes wrong, we can still have the funds and we can recover the funds.
Yeah. What about, other parts like the infrastructure? I guess in other markets where we have clearing houses, which evolved hundreds of years ago, to solve these very similar problems as well, so that we didn't have so many different counterparties that were all trying to settle with each other, and we have all this kind of ecosystem of multiple exchanges. There was no notion of clearing between them. I guess Tether was the first kind of new, very novel approach to inter-exchange clearing and settlement. Which is one approach. Obviously, the question whether people trust Tether or not, it still remains the most liquid or the most utilised of the stable coins, mostly because it has the liquidity against Bitcoin. So it becomes very difficult to move away from it. But we've got Circle's version, Paxos as well, and then maybe Libra coming along. Do we need to go through all those phases, or are we going to just use technology to bypass them?
Technology will bypass it.
That's good.
Digital assets are a radical disintermediation machine. Okay? all this derivative collateralization, margin management, you know, all this stuff that involves commingling risk, you know, all of that can be solved with like basically posting collateral on chain. Okay? You want to trade with leverage, get collateralized, have an algorithmic way to unwind it, right? All this stuff is just going to become like, again, putting my traditional financial markets hat on, think about the amount of capital that's tied up in financial institutions around, you know, derivative collateralization, counterparty risk. If all this stuff is just like, you know where the assets are segregated and they're split effectively, like in the end, it's always just slicing and dicing of cash flows and leverage, right? It's all gonna go on chain. It's all gonna be way, way, way more efficient. And the bank regulators, once they start wrapping their minds around this, and it will take like 10, 15 years, will be very excited about this because it will reduce counterparty risk in the system and a massive uptick in capital efficiency. And the clearing and the settlement, all this stuff will just all happen automatically on chain, very, very transparently. And it'll be boring. And boring is good when it comes to like, you know, managing counterparty risk and finance. Yeah.
Sorry.
So yeah, I don't agree with that. It's a summary. My background is 15 years as a technologist before being an entrepreneur for approaching a decade now, so I'm showing my age. I think that Bitcoin and cryptocurrencies, but let's talk about Bitcoin because that is the one that has a use case that's been proven. I do agree with that. Minimizes trust for one thing, but it doesn't necessarily help with everything else. Now, talking about, I was going to mention on the previous question, but it relates to this. You have this old boys club of large institutions who will want to see other large institutions that they recognize before they enter providing custody, etc. So even if some of the larger institutions in the existing space come into the space and add custody, until it's a state street, some of the large institutions are not going to deal with it. But what we will see here, as opposed to technologies like smart contracts, because when you actually get down into the code, there's still a lot of work to do before it can be this boring thing. And then maybe that can happen, but we're talking about decades for that to get to that point. Because you've got to build some very basic technological primitives in place, and they have to be bulletproof and reliable for a number of years before you can build on top of them. You're going to need, for many years, if not decades, you're going to need a trusted and a new girls' network almost to replace the old boys' network. And that will be people like Nabu, etc., who provide solutions where you have to have trusted people as part of it and technology working in concert. So basic primitive technology that's been developed in a very reliable way and trusted people providing that. Other organizations like BitGo, etc., these new generations will provide services to the new generations of organizations. And the traditional players, when they enter the market, will provide services to the traditional institutions as well.
Yeah, I mean, I kind of agree, and I think it's for what's reported to be these trustless systems, they still seem to require a lot of trust for now. It's how you kind of, I guess, start cutting the tethers gradually along the way and building that trust over time. So I guess it will take time. So I guess the other thing that loops into this whole settlement and clearing and infrastructure, we mentioned it before, I guess we spoke about Libra and some other stable coins. I mean, if you're going to have a financial system where you're trading currencies against each other and you have to settle payment versus payment or assets versus a currency and delivery versus payment, the fiat system isn't going to go away anytime soon. And there's an argument that actually Bitcoin and a tokenized fiat system could actually work as a good counterweight to each other. The argument that Bitcoin's too rigid could be, if you start having a programmatic fiat system, then they can compete against each other, and as long as the fiat system's doing what it should be doing, there won't be a huge rush to Bitcoin and vice versa. So is Libra going to, is that just another big step in the right direction? I mean, I saw already this week they got a congressional cease and desist order, less than a month in. Based in Switzerland, Americans panicking they're just going to be the new kind of Swiss banking system, I guess. And then the other side of that, for me, Libra, irrespective of what you can do with its currency, because that just comes down to the trustworthiness of the issuers, it's an identity system at the end of the day, and it's got identity baked into it. And you could argue that with cryptocurrencies in general, if they're going to become globally friendly, then identity is the kind of the killer app that might do that. Where do we see this going? Is this a good thing? I mean, you said, Charles, that you think it's a good thing. Is that going to be a natural progression, or is this going to take years as well? Has it just got something that we're going to test along the way?
I don't know.
I mean,
It'll take a long time. It'll take a long time, for sure. But yeah, identity is clearly a piece of the puzzle, right? Right now, identity relies on a trusted counterparty to vouch for who you are. Usually that's called the government with your passport. Not always, sometimes it's your bank, sometimes it's your utility, but yeah, but basically there's a ledger and you're a counterparty to it, right? So it's like the credit theory of identity. You know, Bitcoin represents the commodity theory of money, not the credit theory of money. Like, it's a thing you have instead of somebody else's obligation. Identity, it should be the same thing. Like, identity should be a commodity, not a credit. Like, it shouldn't be somebody's IOU to vouch for you. It should be, it's an intrinsic property of who you are. I think the most interesting thing in identity that I've seen is the fact that Microsoft is building it on top of Bitcoin right now. Like a biometric attestation system that takes the ontological fact of your biometrics, puts it on the chain, and then identity is a commodity that that you possess, intrinsic to your very nature, and like that's super cool. What does that mean in terms of infrastructure build out, attestation system? I don't know. But it'll take a while for sure.
Yeah. Commodity money versus credit money, I completely agree. Bitcoin is attempting to specialize in being one of the best value appreciating stores of value there is. And in that space, it has very few competitors. In that space, it's competing against, for most people, property, real estate, and maybe stocks, and very few people nowadays gold as well. So you've got a few competitors, and compared to those, it's 10 to 100 to 1,000 times better today. Mm-hmm. If you want to sell a house to someone else, it's not going to cost you £5 and take 10 minutes. And if you take every other attribute of Bitcoin compared to real estate, it's far, far better. Now, there are other cryptocurrencies, and the majority of them are either trying to be these smart contracting platforms, which are still yet to prove themselves, or they're trying to be a new form of medium of exchange. But there's lots of very good mediums of exchange today. You've got Visa, PayPal, MasterCard, and the list goes on. And Libra has a potential, if it does go live and if it does make it through all the regulatory hurdles that it has to get through, to be the best of breed of the cryptos trying to be the medium of exchange cryptos. If that makes it as good as the existing medium of exchange, that's a different question. But it's definitely the lead contender to be the best built platform. But they serve they're very different markets, and once you start, it will onboard a lot of people into this space. They will start acquiring Libra, and then they will start realizing against this fixed supply value appreciating store of value asset, it starts to still lose value in relative terms, and that will just drive volume over towards Bitcoin. So whatever happens to Libra, it's great news for Bitcoin. Mm-hmm.
So I've forgotten the first part of the question, still recovering from Glastonbury. So Libra, which I think was the second part of the question, I think it's a fantastic thing. And I don't use that word lightly. What they do with it, who's involved with it, I think is largely irrelevant. But what it's managed to do is move the entire industry and give it a little bit of credibility. So 2017, we were really fighting for credibility. It was all, everything's crypto is related to drugs, terrorism, etc., etc. So that conversation, I've seen it with journalists now, has largely died down, and journalists are really thinking twice about whether they can be negative about crypto anymore, and they're actually becoming more and more positive. So I think that's been one good thing. The second aspect of crypto, or the second part we struggle with, is fiat on-ramp, the banking relationships. So if Libra is the entry point into the world of crypto, and they can solve the fiat on-ramp into Libra, and then Libra into any other asset class, that can't be a bad thing either, I think, for the industry, particularly with the reach that they have. So I think whatever they're doing, it's a good thing for the industry. ID, this, that, the other, etc. I don't know. I have to say I don't know which way it will play out. But if they can just fix the credibility and the on-ramp into crypto, I think then for the industry it's a good thing.
Thank you, guys. Just watching the clock. Should I open up to the audience? Do we have any questions in the audience? Questions? I can ask you. Time's nearly up anyway. No? Heard them say it all. I'm sure you can ask them more over some beers and pizzas if Peter's here.
We're almost here.
They're almost here.
My top priority for you the last 5 minutes.
All right. Well, I'll just finish up on one more thing, I guess, because we kind of mentioned past, present, and future, and certainly something we'll look at in future events as well. But see, there's been a lot of work on an experimentation of decentralized exchanges going on. A lot of it's being, I guess, Ethereum was the appropriate network to start experimenting and building upon. We've not seen huge traction from them. I don't know how close you guys have looked at them, what your thoughts are. Obviously, the user experience still is challenging, I guess we should say there. And as as Obi, you mentioned, there's the trust element. If we're trusting a smart contract on a public network to lock up millions, in future tens or hundreds of millions of dollars or pounds, then you better be sure there's not a back door in it. So, have you been looking at anything? Is anything kind of piquing your interest? What's your thoughts on it?
As I said, from a technical point of view, I find decentralized exchanges incredibly interesting. I have to be clear that I mean decentralized exchanges, and there are very few of the exchanges that purport to be decentralized exchanges are actually truly decentralized. And in fact, for them to, one of the key tests will be if they're making any profit, if there's individual organizations making profit, it's not decentralized. There'll have to be a system where no one makes profit, because that would require centralization in and of itself. Now, the ones that are truly decentralized are incredibly slow, they're very limited, and a number of reasons that you have exchanges are to provide liquidity. And the way they currently are, and structurally, they will never be able to be as fast as a centralized system. Because if I have to coordinate across the world, it's not going to be as quick as if I have to coordinate in the memory of a chip on one machine. So there will always be a reason to have centralized exchanges for that. High frequency traders and all this sort of stuff would require that. Decentralized exchanges are very interesting. I know the regulators are incredibly concerned about them as well. But as I said, truly decentralized exchanges are probably a while away, because they will still require trust. Whether it's trust in people, which we understand as human beings, or it's trust in code, that's going to take a while, because very few systems that are complex have 0 bugs in it, and that's what you need to get to for all of these systems to work reliably at scale, holding large amounts of capital.
So the interesting thing about decentralized exchanges, as in any product, it's like manufacturing drugs. So if you're into making drugs, you can make as many drugs as you want, but unless people want to buy them and get high on them, right, and get some win from them, they won't use the drugs. Decentralized exchanges, there are people manufacturing, building, etc., etc., but I can't see a reason for the common man to use a decentralized exchange. If the only reason is anonymity, 98% of the people here don't care about being anonymous. So that leaves 2% of the people. That leaves 2% of the people, you've really got to try hard to get them to use decentralized exchanges. So I think we need to find a USP with a reason behind it, and the reason has got to be bigger than anonymity, at least for me.
Last word on anything else?
I 100% agree with Luke's point, which is, why am I going to get a better fill on a decentralized exchange? Like, if I'm not scared that my relatively modest balance is going to get hacked in some centralized exchange, then why am I going to go trade someplace that's lower for less value? I just care about price and liquidity, right? So it's a pretty big mountain to scale to make it all happen. But I guess things could happen. But I'm never, this is something I learned from commodity world. Never bet against the engineers, right? The world's going to run out of oil. Guess what? The engineers found more oil, right? So I mean, I guess I would just say, too soon to tell, basically. I agree that architecture doesn't support HFT fundamentally. point, that's for sure. But who needs HFT? Do you need HFT or not? I think it's a different question.
I think we do have one question coming up here.
Yes, we do. Just a cheesy question, and I caveat it, there's no body parts need to be eaten if you get it wrong. I'd like to hear all 4 of your 12-month price target. No body parts have to be eaten.
I wrote mine publicly a year and a half ago. It's tied in with yours at the beginning, 67,000 plus or minus 20% by mid-2020. So here it goes.
But for me, it's probably 25K-ish by end of this year, with a little pullback afterwards, and then end of next year. I think the 30 to 50 is feasible.
I never give predictions.
Do it.
I'm going to do it today, but this is my personal prediction. I think that being in the teens for this year, up and down, slowly rising, makes sense. But I would expect it to be much higher than that by the end of next year. So the plus end of the above the 60, around the 60 or above by the end of the year.
So disclaimer, not allowed to give financial advice.
I was going to go and trade on the back.
I just wanted to throw that out there. So I made a bet last year that in Christmas 2018 it would be $84,000, and I lost that bet.
You made that bet on eToro.
So in 12 months' time, I'm again going to go at $84,000. Having to take the bet the other way as well. If it's $0, I'll take everybody's Bitcoin. That's my goal.
One day you'll be right.
One day I'll be right. So I'm sticking to $84,000.
Thank you.
Excellent. Thank you to all of our panelists. Thank you all for coming.